Well, good afternoon, everyone. Welcome to Trade Talks. My name is Chris Dearborn. I'm a Managing Director on Nasdaq's Market Intelligence Desk, and I'm filling in for our venerable host, Jill Malandrino. Joining me today from the Nasdaq Market Intelligence Desk is my colleague in crime, Brian Joyce. Brian Joyce is a CMT, and we're going to be showing a couple of charts today, recapping the action that we've seen in the market over the last few weeks and what we think might continue to happen moving forward. So looking back at the week ahead, Brian, thanks for joining us.
Thank you for having me.
Excellent. We've had a significant amount of items happen to us here, and one of which is a big rally in the markets. We're poised to be up for our third week in a row. And on the back of that, you've seen a number of different items coming into the market. You've seen oil, you see the Fed minutes, you've seen record unemployment. We had okay CPI numbers today. What are you noticing with oil to start off here?
Well, oil, as we know, in the fourth quarter was leading the equities to the downside. Oil corrected 45%, bottomed on Christmas Eve, December 24th. Equities bottomed one session later on the 26th. Oil has seen a phenomenal rebound to a high today of 25% off of those December 24th lows. So 25% in less than 3 weeks' time. Big move. It's hitting right now some technical resistance, some minor technical resistance, I would say, at the 50-day moving average. One thing to note is when it bottomed on December 24th at 42.5, that was a clearly defined technical support level representing the lows seen in 16 and 2017. So I do think it could have some more room to the upside here, which would be up to 55, but it's getting pretty close to that level now, just maybe 3 or 4 percentage points away from that level. So at any point from here going forward, it would not surprise me to see this uptrend kind of stall out a little bit and maybe see some corrective price action where you can work off this recent frothy type of price action to the upside.
Excellent. Another item we've seen talking about what's been moving the markets here is the Fed, and specifically Chairman Powell and the rest of the group walking back the comments from the last rate hike. We've seen a lot of commentary coming off of the term patient, and we've seen the Fed fund futures actually decrease to almost a Fed cut as opposed to a Fed hike for 2019. What have you seen about that?
So markets right now are pricing in less than one rate hike for 2019. Very different from what we saw maybe 6 weeks ago, where they were pricing in, up to maybe 2, sometimes in cases 3 rate hikes. So the message out of the Fed has been very confusing. They, were seen as initially hawkish in early October, kind of sparked the downtrend. They did a 180 in late November, which led to one of the best 5-day performances in the equity indices in about 7 years. And then following the most recent Fed meeting, there was some uncertainty about or some uncomfortable response within the marketplace regarding the autopilot commentary, specifically as it regards to the quantitative tightening of the reducing the balance sheet of a maximum $50 billion a month. Essentially what they seem to say, what Jay Powell seemed to say, is he doesn't really see that as much as a tightening in the marketplace of liquidity, financial conditions, so to speak, which seemed to contradict what prior Chairman Bernanke and Janet Yellen had said when we were doing QE, which was to provide liquidity, to boost asset prices, to increase the wealth effect. So if we're doing the opposite now, why wouldn't that have the opposite effect on markets and liquidity? Which, when you look at certain measures of liquidity that are out there and volumes that are trading, especially in the futures markets, what's out there on the bid, what's out there on the offer, there are a lot of different measures out there to look at liquidity. It does seem to be coming down quite a bit and could be exasperating these moves we've been seeing into the end of the year.
Well, that kind of goes into the comments that the Fed has always been data dependent, looking backwards and what's been driving the markets, and not so much as forward looking, where we've been talking recently about being market dependent. We've had some very good economic data recently, and it's been continuing. You've had record low unemployment. You have consumer confidence that continues to grow. You've seen supposedly a record spend here in Q4, which is going to drive consumer strength, which at the end of the day drives GDP. But really, what are we seeing here? Are we seeing inflationary items coming in? The CPI numbers today showed that inflation is kind of still strong, creeping back in there. Gasoline was the big driver of why we had a lower CPI today. It's down, I think, accounted for almost 7% of that, based off of the price in oil that we just saw recently. But you're seeing housing increase. You're seeing other goods increasing. Is the consumer really able to take on those prices?
Well, it is interesting that we did this week, just a couple of days ago, have the, actually it was yesterday, we had a number of retailers come out with disappointing holiday sales figures. We saw it from Macy's, from Kohl's, from Target. Macy's yesterday had one of its worst one-day performances in the stock's history. So In saying that, the retail sector did come off a relatively good 2018. Certainly sold off very strong in the fourth quarter, down 28% for the S&P Retail Index. In saying that, it rallied stronger than the market these last 3 weeks. It was up 17% going into yesterday's price action. So, and initially off the open yesterday, the retail index opened down, it gapped down more than 4%, but finished down less than 2%, and then today saw additional upside follow through. So it'll be interesting to see what it's doing from here. The market, I think, has been behaving very technically here. So the retail index is stalling right now at its 50-day moving average. That was the high yesterday, and it's getting close to that level again today. Same level where the S&P 500 is beginning to stall, the Russell 2000, and earlier, as we were highlighting, the price of oil is also stalling right there as well.
So we got another chart to put up here, the S&P 500, which Leanne's going to show to everyone on screen. And with that, can you walk us through what we're seeing here?
So for the S&P 500, we recently bottomed at in the high 2300s. And what's interesting here is that I don't think we put in the low for the market. Or if that is the low, I do think we will at some point, potentially in the very near future, in late January into February, retest those lows. And the reason I think so is because of the breadth. In October, when we bottomed down around the 2650 level, we had a 10% correction, and we bounced higher from there. At that point, at the October low, 19% of the index was making new 52-week lows. In November, when we retested those lows, only 8% of the index. So that was your positive divergence with breadth. Only 8% of the index was making new lows versus 19% the prior month, and we did, in fact, see a rally back up towards 2,800. It didn't get as high as the initial rally earlier in the month. And then everything rolled over, as we know, in early December for various reasons. Maybe it was the Fed, maybe it was China, maybe it's the looming government shutdown that we're now going through. And the S&P 500 then went on to make that December 24th low, at which point nearly 50% of the index was making fresh 52-week lows. So what I'm now expecting is a retest of those December lows, and hopefully then we'll see some positive breadth, a retest of the lows with fewer stocks making 52-week lows. Another breadth indicator that a lot of eyes are focused on is the percentage of the index that is trading below the 200-day. That bottomed on the 24th, roughly around 9-10%. That was a multi-year low, either the first or the second worst reading since we came out of the Great Recession. So we'd look to see that number improve as well on the retest.
You know, another indicator that we have talking about here that the market's a little bit in rally mode is the VIX. We finally got a VIX handle below 20. Again, the VIX is the fear gauge, basically validating moves to the downside. A higher VIX means a lower market. A lower VIX means a higher market. With a VIX handle below 20, a 19 number, for the month of December, we've been trading in the 20, if not hitting high 30 numbers. Prior to that, we haven't seen a 20 handle with more than a handful of days going back to February 2018. What do you see with the VIX?
So with the VIX, I don't look at it so much as a leading indicator. For me, it seems to be more of a coincidental indicator, but it certainly did affirm the volatility that we saw, especially in December. The VIX got as high as, I believe, is the 36 level, which it hadn't seen in quite some time. So it has now pulled back. It is nice to see that we are showing some pretty good volumes here in January. We're averaging well over the 12-month average. Yesterday maybe was a little bit light. Today's a little bit light as well. Today, though, it's nice to see light volume when the markets are pulling back a little bit. I think the Russell today may have gone positive, red to green, which is good to see. But but you do want to see that lighter volume on the corrective price action. What I would note is that we did see on Wednesday when the Fed minutes came out, which were certainly well received by the marketplace, we did see a breadth thrust where the number of advancers versus decliners. That volume was about a 10-to-1 ratio. So it's nice to see that upside gap with that strong skew towards the positive volume versus the negative volume. It's not commonly seen, and oftentimes you may see that when the market takes off from a meaningful low. Again, I do expect we will retest those lows from December, but we'll have to wait and see. Nothing's a guarantee.
You know, speaking of retesting, the dollar has been making higher highs here, going across the board. Again, correlating directly to what we've been speaking about with the broader market. What do you see in the dollar?
Well, the dollar did make a higher high in December, a very marginal new high, but intraday was unable to hold those highs and has pulled back. It's since been pulling back a fair amount. It's pulled back below the 50, the 100, and as of a day or two ago, I think on Wednesday, it had a breakdown below the 150-day moving average, where it held for a few days. There was a couple of speeches by a couple of Fed presidents that were received to be dovish, and that was the the catalyst behind that thrust lower. Particularly now, when we speak about the dollar, I generally am speaking about the basket, which is heavily skewed towards Europe and the euro. However, if you compare it to the Asian index, there's a JP Morgan Asian index, if you're using a Bloomberg terminal, ABXY is your ticker, you can see there's been quite a phenomenal rebound in Asian currencies versus the dollar, so the dollar is weakening versus those currencies. And that's certainly something to note. If we look at what dollar is doing versus the Chinese yuan, that particular currency pair is extremely important because the yuan has been depreciating for much of 2018 as overseas markets, as the Shanghai Composite has been in decline. And most recently, what we've been seeing is an appreciation with the Chinese yuan. We had a technician in here yesterday from Bank of America, Paul Siena, who was highlighting that his interpretation of that was that markets were looking for a relatively positive outcome from these trade talks that we were having between China, President Xi, and President Trump.
So that's kind of segues into the last chart that we have here, which is the Shanghai Composite. What are we looking at here?
So the Shanghai Composite had a very difficult 2018, down as much as 32%. It actually bottomed just last week, which certainly makes one think it could certainly make low lows from here. But the level it bottomed at was nearly identical, marginally lower from its level back in October. So we have a potential here for a double bottom low. What I like about it is when we look at the long-term, multi-year, 10, 15-year time frame, we see two technical levels coming in here. The prior highs from 2012 and 2013 are now acting as support. That's the level where it bottomed in October and retested last week. And it also coincides with the rising trend line connecting the lows from 2005 and 2012-13. So that certainly is your cluster right there of technical support, both on the intermediate and the longer-term cyclical timeframes. And given what we're seeing with the currency, with the Chinese yuan, as well as the entire basket of Asian currencies, I think you have a setup here that provides a pretty attractive risk reward. At the very least, is certainly looks like maybe a good entry to start building a position in those overseas stocks, those overseas emerging markets.
All right, so next week we got a number of different items with the government entering its 21st day of the shutdown and really no sight of the two parties getting this government budget done. There's a fair amount of economic data that may be on hold for next week. So we're looking at PPI on Tuesday, producer price index, retail sales, which if the government is shut down, will not be put out. And then Thursday we have jobless claims as well. Week ahead on earnings, the banks kick it off and we start an earnings season. Brian, thank you so much for joining me today. I'm Chris Dearborn from Nasdaq's Market Intelligence Desk. Thank you for joining us on Trade Talks.